Debt versus equity investments in your IRA. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. In today's video, I want to explain the difference between an equity and a debt investment using an IRA. Now, this question comes up a lot, and it's okay. People get confused by debt and equity investments. Okay, whether you are an attorney, an accountant, a businessman, successful entrepreneur, I get these questions all the time. I'm making this investment. It seems like an equity investment, or is it a debt investment? How does it work? So let's start with equity. An equity investment is basically like buying Apple stock. You are investing money, and in return, you're getting an interest in that business, whether it's shares in a corporation, interest or units in an LLC. That means there is no stated rate of return, right? I can invest 50 grand in Apple, and maybe I can sell my $50,000 of stock for 100, or maybe I'll sell it for 50 or 20 or 40 or 30. There's no guaranteed rate of return, right? That's an equity investment. There's upside on an equity investment, right? If Apple, that share goes from $50 to $1,000, pretty good. The share could also go from 50 to 0. There's no guaranteed rate of return. On the other hand, a debt investment is a loan, right? I lend Jane $100,000, or I lend ABC Corporation $100,000, or I buy a bond from Apple. That's a loan transaction. That means I receive a stated rate of return, whether it's 5%, 10%, 15%, generally has a maturity, 5 years, 10 years, 15 years. But the main difference is there's a guaranteed rate of return. Now, it could be a balloon payment where I get it at the end, or it could be just monthly or quarterly payments, versus an equity arrangement where I get the upside, I own equity, but I don't have any rate of return. So I get this question all the time. Hey, Adam, I'm investing in this deal and I'm getting 30% of the profits, but it's a loan, right? I'm lending $50,000 to the company, but they're giving me 30% of the profit. And I always tell the client, no. You can call it anything you want. You can call it Swiss cheese. It's equity. Why? It's not guaranteed. It's based off your profits. If profits is 0, 30% is 0, 0. If the profits are $1 million, 30% of $1 million. So that's not a loan arrangement. That's an equity arrangement. You can call it a loan. You can call it Swiss cheese. I don't really care. But if the IRS looks at it, it's going to be equity. Why does it matter from an IRS standpoint when it comes to self-directed investments? Well, if your IRA is investing in an LLC and you make an equity investment and there's more than $1,000 in net income and it's a business, that could be subject to UBIT, unrelated business income tax, which has a tax rate of 37%. Whereas if you did a loan to that business, interest is not subject to UBIT. Why? It's a passive form of income, like capital gains, like rental income, like dividends, like royalties. Okay, so that's why debt versus equity is a very, very important distinction when it comes to IRA investments with respect to the application of the unrelated business income tax. Otherwise, I don't really care. Okay, how you want to call it, debt versus equity, doesn't really matter. It only really matters to UBIT. So if UBIT wasn't in the book, if it wasn't in the tax code, if it didn't apply to IRAs, I wouldn't really care. You can call it debt, call it equity, who cares? But UBIT's real, and it can turn a very, very attractive investment into a very, very tax unfriendly investment if that 37% tax applies to the UBIT investment. Now, corporations block UBIT. So whether you call it a debt or equity investment into a corp, I don't care. It's when it's an LLC investment. Debt, not subject to UBIT. Equity investments into an LLC, if that LLC is a business, could trigger UBIT. Hope that makes a lot of sense. It's a confusing topic because you have, or you can have, these instruments, these structures where it looks like debt, it looks like equity, or what about convertible notes, right? What about a note that starts at debt and then converts to equity? Well, when it's a debt note, it's not subject to UBIT. As soon as you convert it to equity, it becomes equity. And if you are converting to an LLC equity arrangement, you'll have UBIT, whereas if it converts to stock, you will not have UBIT. So if you want to learn more about debt versus equity and the application of the unrelated business income tax rules, give us a call. Our self-directed retirement experts are standing by and will love to help you out.